recording, and hopefully, I don't know what happened last week, but when I went to the recording loaded, uploaded properly, but when I went to find it, it was nowhere to be found on my computer. It was weird. So hopefully this works this week. Okay, that's new. So this week, I wanted to talk about one of the upcoming chapters from the second edition of How to Value Invest. Is Paradise Inc. And I'm getting to it right now, and I'll share my screen with you guys when I get there.
But what is Paradise Inc?
It's a small $12 million company when I first found it that is liquidating right now. We haven't talked about a liquidation situation before, frankly, because they're very, very, very rare.
Mm-hmm. Yeah, that's true.
So, okay, I'll show my screen now. Let me know when you guys can see it.
I can see it.
Okay, so this right here, and I think it's like 30 or 40 pages long. We're not going to go over all of it, obviously, today. But the reason I want to show you guys this is because, a liquidation situation is extremely rare. This I've learned about them and I've known about them, but this is actually the first one I've ever evaluated or I've ever seen on a company I own. I've owned stock in this company for 6-7 years now. So I'm very, very familiar with this company. Actually, this company is based about 35 minutes from my house right now. I've not visited them specifically, but they are based about 35 minutes from my house. So the kind of original thesis on this company was extreme undervaluation. I think they were selling for $15, $20 a share when I found them, and I valued them to be worth up to around $50 to $100 per share, depending on which valuation you used and what you included in the valuation.
Mm-hmm.
So the valuation was massive. They were valued when I first found them as if they were going out of business. The reproduction valuation, liquidation valuation we talked about last week. Oh, the asset reproduction valuation, sorry, that we talked about last week. They're a profitable company when I found them selling below that value, which is absolutely insane. Again, something you rarely ever see. Why were they selling at that price? Because, do you guys have a guess? I think, David, you said you've read my book before. No, they weren't in the first book, I don't think. You guys have a guess at what their product is?
Why it's undervalued?
No, do you have any idea what their industry they work in is? Because I've written about them on the blog significantly, so I'm just curious if you guys have read those pieces at all.
Is this a candy one? Candy?
Yes. Candied fruit, called glace fruit, like the candied fruit that goes into fruit cakes specifically. I don't like. I've never had a fruit cake. Fruit cakes are popular here in the United States.
Yeah, I've never heard.
I don't understand.
So, why would I ever in a million years invest in a fruitcake company? I've never had it. Americans typically hate fruitcake. I don't know about.
So, fruit cake already made, like that you buy in the shop, or? So
they don't actually make the fruitcake. They make the little candied fruits that go inside the fruit.
Okay.
So the little pieces of pineapple or strawberries or whatever, the cherries, they make those little pieces of candied fruit.
Mm-hmm. Okay, understood.
So in a million years, why would I ever invest in a fruitcake company? Ever. Because it's massively undervalued. That is the first kind of reason I bought when I bought in, again, 2013, 2014 timeframe, somewhere around there. As I continued to learn more and more, I saw massive potential here. And this is what this letter is. I actually sent this letter to company managers with my recommendations on how to improve the company and telling them that I wanted to buy a significant amount of the company or the entire company for around $20 million. I don't have $20 million, but if they would have agreed to my price, I would have found the $20 million to buy it because there's massive potential here. You guys are familiar with See's Candies, right?
Yeah.
So See's Candies, Warren Buffett bought See's Candies originally for $25 million in 1972. Since 1972 up until I think 2012 is the last time he released information on it, See's Candies produced $1.9 billion in operating profit for a purchase price of $25 million. Since 1972, when he and Munger bought See's Candies, they only had to put an extra $40 million into the company. They used the rest of that, what they call excess cash flow, to invest in other assets and companies. So they essentially bought See's Candies for $25 million, put $40 million extra, so total purchase price of $65 million over the years. And this $65 million produced $1.9 billion in operating profit. Insane, right?
Yeah.
So yeah. Buffett used See's Candies as a way to build excess cash flow, to buy other assets like his Coca-Cola shares, his other companies, to produce more and more cash flow that he can then buy other assets with. So this is what he's built his entire investment snowball on. This is a lot of the stuff we're going to talk about today is a lot of the stuff I talk about with these companies. Not in this depth that we're going to get into, but proper capital allocation, if you do it well, leads to this virtuous cycle of ever more cash flow that you can invest in other assets. And then if you invest the money well, that leads to higher values of the company, more cash flow, and the cycle just repeats and repeats and repeats. Does that make sense? So I see the same thing as See's Candy or at Paradise that I see at See's Candy. Paradise, again, I originally bought because it's massively undervalued. That was pretty much the only reason. I treated it like a Ben Graham, NCAV type company. But the more I learned about capital allocation and free cash flow and excess cash flow, I saw a lot of similarities to Paradise Inc. and See's Candy because it's at Paradise Inc. They've done sales over the last decade of between 24 and like $27 million every year. And it's been steady the entire time. The fruitcake industry is dying in the United States. It's been dying for decades. People my generation or our generation and younger have either never tried fruitcake or hate it. I know literally no one our age or younger that likes fruitcake. So the industry is dying. So my entire 30-page article here that I sent to company managers was not only telling them how to improve profitability margins now and improve excess cash flow now, but how to transition the company from what it is now and only a glazed fruitcake company to becoming a Berkshire-like entity buying other assets with the excess cash flow. So let's get in. This is just introductory stuff. How insane is that?
I wonder how this does compare to Hershey. I'm just curious.
Hershey does the same thing. They started out with just the Hershey's chocolate bar, and now they've expanded out massively. They own a ton of candies and candy companies now. They do the same thing, except they pretty much specifically focus on the candy arena. They don't expand out like Berkshire does into other industries and stuff like that, but they have expanded into other candy companies. Okay, I've got presentations on this that I've built for these alpha capital allocation companies. I haven't presented this presentation yet, but I've built an entire presentation essentially outlining how Warren Buffett, the name of the presentation is how Buffett turned $100,000, which is his original investment capital, into $530 billion. Which just saying that sounds insane. $100,000 into $530 billion, but he legitimately did it. And this is exactly how he did it. And I go through this in this article, and I actually evaluate every single one of their SKUs on Amazon, figured out they have pricing power. Are you guys familiar with that? I don't think we've talked about pricing power before.
I don't know if we talked before about, but it's like they can decide, they have pricing power on the product that they sell.
Yes. What does that mean?
So it means that even if they put a little higher, they can still sell the same amount of product because they have like a brand, a name behind it. So they have like a customer base that can accept even a higher price, like Amazon with Amazon Prime, for example. They have pricing power there because they keep putting higher price for the same service, and the people still accept that because they are already using the service. They are good with that. So until some point, they will accept any price, I think.
What does that mean from the company perspective? If you can raise prices without
they can raise their profit margin.
Yes.
So the margin can go higher and higher.
Yes, profit margins go up. That's all profit margins. That's gross income, that's operating income, that's net income, that's owner's earnings. All profitability, that's ROIC, ROCE, unlevered return on net tangible equity. All these important, ultra important profitability margins and metrics go up.
Mm-hmm.
Why is that?
Yeah, because they can deliver the same product, so with the same cost at a higher price.
Yes. So essentially, the way I explain this to companies that Shafiq and I are pitching is, if you can raise prices, it doesn't raise your costs. If you raise your price from $1,000 to $1,500, you increase your margin by 50%, and no costs are raised at all. I mean, you might lose some customers, you might lose some revenue, and that's a game you have to play. Is, should I raise 5%? Should I raise 10%? Should I raise 25%? What is the kind of level that you need to raise? But generally, if you raise prices by 10 percentage points, typically your margins will go up by 10 percentage points if you can keep your costs under control.
I mean, if you have pricing power, it means that it's likely that you will not lose the customer base that you have.
Yes. If you don't raise it astronomical amounts.
Yeah, if you don't have pricing power, it means that actually you can't do that. So you have to have more than a unique product, something that the people like and they are familiar with, so they will not change your product for another, because for just to save that little money, it's not, I mean, the switching cost, it's not so high for them.
Yes.
To take all the trouble to change to another service.
Yes. So let me ask you guys a question. We've talked about competitive advantages quite a bit. We've talked about pricing power pretty much today only, I think. What do you think is more rare? A sustainable competitive advantage over the long term or pricing power?
I mean, for competitive advantage, what do you mean? Like that you have some
Like
kind of
any competitive advantage, economies of scale, network effects, patents, all those kind of things. Any, just in general.
I think
I
pricing
think that
power.
pricing power, yeah, it's more difficult because it means that you have. I mean, everyone wants to save money, so have the power to charge more for the same product, the same service. It's not easy.
Yes. So you guys are correct. So I've, over the last 12 plus years, I've evaluated thousands of companies from all over the world. I've seen, off the top of my head, I can think of probably 4 or 5 companies that I've seen have pricing power. That's it.
What were they? What were they? What company?
Altria, Philip Morris, cigarette companies. They obviously have pricing power because their product's addictive. That's part of it, and they have economies of scale and all that kind of stuff. So, and before I get to that, before I finish answering that, when you have pricing power, you likely have some term of economies of scale, powerful brand name, network effects. You probably do have some competitive, or you most likely do have some competitive advantages. But just because you have competitive advantages doesn't mean you have pricing power. Does that make sense?
Yeah.
So Philip Morris, Altria, both cigarette companies. There's Paradise Inc. right here. See's Candy. And
Google.
yeah, and I mean, that's off the top of my head. I mean, I'm sure I could find more over the years I've done research, but off the top of my head, that's it. So if you find a company that has pricing power and it's legitimate, you need to look very deep into the company, because not only is it incredibly powerful, but it's incredibly rare just to learn from. Just from a learning perspective, incredibly rare. So what I found is this company has pricing power because it owns 85% of the glazed fruit market. So 85% of a dying industry is still a significant portion of that industry. So they could raise prices if they wanted to. They haven't raised prices. I don't know if they have ever raised prices. In my opinion, they're probably selling products and prices at barely the cost of goods sold, because they haven't raised prices as inflation has continued to go up, as their costs have continued to go up. They haven't raised prices. Why haven't they raised prices? Do you guys have an idea?
They want to sell more volume. I don't know.
That's a good guess. Too logical, though. Most companies don't know anything about pricing power.
Yep.
They just simply keep doing what they've done over the years because that's what they've always done. They don't know anything about pricing power. Again, it's incredibly rare, and most company managers know nothing about capital allocation. Nothing. So this goes in pricing power and capital allocation, or pricing power goes with capital allocation, and most companies know nothing about capital allocation, so they know nothing about pricing power. They probably never even heard the term. I mean, if you bring up the term, they'll probably knows what it means, but they probably never even heard the term pricing power, unless they've studied capital allocation, which again, almost none have. Another thing that goes in with this is I found that they could cut costs. So this is what I call, and again, I have a presentation on this too, I call the pillars of capital allocation. Typically, if you can raise prices, you should raise prices. You should also work to cut costs as well. If you can do both of these things, which I found Paradise could do, it would literally have doubled or quadrupled their operating profit and free cash flow with 0 rises in costs. That is incredibly powerful. It's very hard for companies to improve their profit margins by 1 or 2 percentage points over a 5-year period if they're a decent sized company. But if you can double or quadruple your operating profit and free cash flow with 0 rises in costs, what do you think that would do to the value of the company over time? Explode the value of the company, right?
Yeah.
Yep.
So I recommended all these kinds of things and more. Again, I'm not going to go through this whole thing. I'll send this portion of the book to you guys if you want it. Only me, the guy who is helping me write this to send to the company, and the guy who copy edited it for me, and I think maybe one other person has seen this article. I've not released this or shown this to anyone else. So if you guys want to see this, let me know and I'll send it to you, or I'll post it in the Facebook masterclass group, because it's I spent 4 months on this article and the research that went into this article so I could simplify things and present them to the company managers in the hopes they were going to let me buy the company. So the reason I'm talking about all of this today, pricing power, and again, I go into margins and all this and how it improves everything. Retained earnings, we've talked about all this kind of stuff. I'll send you guys the article. The reason I'm talking about all of this is because this company did not listen to me. They did not even respond to me. And they're now liquidating. What does that mean? Again, I know we've talked about the term liquidation before, but we've never talked about a liquidation. Essentially, this is a liquidation special situation. What does that mean kind of in a real world sense? Do you guys have a guess?
They're shutting down the business, obviously.
Yes. So.
But so to sell it's fruit business and the liquidation are different kind of things, no?
Yes.
I mean, liquidation it means that you sell everything that you have, like machine, all these things, after you pay your debt. To sell it's fruit business, you can sell even at a good price if you sell to another business, your business unit. So
this company is actually doing a dual liquidation, I guess. It's selling its fruit part of the business and it's liquidating everything else. So it's selling its operations in the fruit business to Seneca Food Corporation, and it's liquidating the leftover real estate. I think the plastic business that might be going. I'm not sure. I haven't read this in a while. This came out in April. So they might be selling. They have a plastics part of the business and a fruit part of the business. The plastics part of the business is smaller. They help with packaging their products and other people's products, stuff like that. But they're selling essentially the operations to this company, and they're liquidating the real estate. So you're correct. There is a difference. Essentially, liquidating means they're going to sell the real estate and they're going to pay shareholders whatever net proceeds come after taxes and fees and all that stuff. They're going to pay shareholders for the amount of money they get from liquidating the real estate. But it's an important difference because not only are shareholders getting here the sale price from the operations, but on top of that, the real estate they do keep, they're liquidating that, and shareholders are going to get both pieces of the proceeds from the sale. So why is that important? Because I said I wanted to take the company, or I wanted to buy the company or buy a significant portion for a valuation of $20 million. This was I think I sent this out early January 7th, 2017 or late 2016. So 2.5 years ago. The company now, by my calculations, and again, this isn't finalized, and they obviously real estate values and business values change over time. So they haven't got a full value yet. But by my estimates, they're liquidating. By the time liquidation is done, shareholders will receive between $15 and $25 million total to essentially go away. The company will cease to exist as they know it, or as we know it now, will cease to exist after they sell their operations and liquidate the real estate for between $15 and $25 million after taxes and all that stuff. This is frustrating to me because, actually, let me back up. The founder of the company is approaching 90 years old. He is still the chairman, but as far as I know, he doesn't run any day-to-day operations. His kids, and I think there's a cousin and a son-in-law or daughter-in-law, something like that, that run essentially the company, CEOs, COOs, lawyers, all that kind of stuff. So it's pretty much a family started by the dad, or a family-run business started by the dad, and the kids run it now. Kids and family members, second generation runs it now. My guess is that they essentially don't want to run the business at all, and they just want to get out and make money. That's my guess. But it's frustrating from my perspective is because what I see from them is not exactly See's Candies, because I don't think they have the pricing power of See's Candies in terms of the long term. They can raise prices probably 10% per year in the short term, but not every year like See's Candies. But they still have the excess cash flow that they could use to invest to turn into a bigger and greater company if they wanted to. And that's what's so frustrating to me, because legitimately I think they could and should do that, because over the long term they could turn whatever, let's say $20 million into 100, 150, $200 million easily in time if they were to run the business better, again, cutting costs, raising prices, those kind of things, and investing in other assets. Well, why are liquidations so rare? Do you guys have a guess?
Could the CEO and board of directors lose their job?
Yes. So liquidations, company managers have an ego. We all have an ego, but typically if you found a company, you run a company, you're a CEO of a company, you have a large ego. You kind of have to have belief in your abilities to get to that level. $20 million company, you're doing a pretty good job, or a very good job, I would say. But when it comes to the first generation who actually built the company, transitioning to the second and third generations, they don't have the same drive. They don't have the same kind of emotional attachment to the company. They don't necessarily want to be in the fruitcake industry. Again, who wants to be in the fruitcake industry? Nobody. I never in a million years thought I would buy a fruitcake company, because again, I've never even had it. And I don't know anybody who even likes it. My parents are in their mid 50s, and they don't even like fruitcake. So it's kind of crazy to think, hey, I'm going to buy a public company stock in a fruitcake business. Oh, this is going to end it well. It's kind of silly when you actually think about it, but it's frustrating from my perspective, because I see what this company could become, and I see a vision of See's Candy, similar to See's Candy, or even actually probably a better thought, now that I think about it, is Berkshire Hathaway itself. When Buffett bought Berkshire Hathaway, he bought it. Do you guys know that story of what he bought?
Was it like he bought it, and then like something like he wanted to pay a low price, but then someone tried to like screw him over in the deal, and he ended up buying the whole company. So it would piss the person
Yeah,
off.
the owner essentially made Buffett angry, and you don't want to mess with Buffett when he's angry, just like Hulk, apparently, because instead of buying a portion of the company, he bought the whole thing. It was a textile company, not making any money. He thought he could
Was
turn.
Berkshire, no? Was
Huh?
Berkshire Hathaway? Was Berkshire Hathaway, no?
Yeah, it was a textile company, making like clothes and stuff back in the day. Wasn't making much money, wasn't very profitable, required a lot of capex. And Buffett tried to keep it going as long as he could, but eventually he realized what I'm talking about now is this company is going to die at some point, and we have to transition. We have to use the excess cash we have now to buy other businesses and assets because this business is going to die at some point. That's what I see with See's Candy. The business is, as the main business, original business in the fruitcake business, is going to die at some point. But by my estimates, they have between $500,000 and $1.5 million in excess cash flow per year that they could invest into other assets to build, again, their mini Berkshire Hathaway. And even when you think about it that way, a $12 million company, which it was when I first bought it, producing $500,000 to $1.5 million in excess cash flow per year, that's what percentage is that per year? What return? Look at that as a return. What return are you getting on your cash per year? And that's what, about 8% to about 12%. Is that right, David, off the top of my head? So you could look at that as I'm earning an 8 to 12% cash on cash return, like in a real estate investment. But are you really earning that return if you're not investing it well? The company managers, what they decided to do, instead of investing in other assets, they decided to pay dividends. Why? You have a guess as to why?
So they decided to pay dividends?
Yes. Do you have a guess as to why?
Because they own the company?
Yes. So they own.
There's all, yeah.
So
Like,
they're essentially not only paying their salaries, they're paying themselves bonuses in the form of dividends because they own such a huge portion of the company. So
40%.
So they're, again, we all want to be rich. I want to be rich. What I've talked with you guys, I have no problem with people becoming rich. I think tax the rich at 50 to 85% is absolutely insane, which is going on in the U.S. right now. The left in the United States and the progressives in the United States want to tax people at 50 to 80%, which I think is absolutely insane. I want everybody to be rich. I want to make as much money as I can. But when it happens and you're a public company and you're essentially taking shareholder capital and paying yourself more shareholder capital over and over, and you're not working to grow the company, that's when it drives me nuts. And that's essentially what this company is doing over the last 7 to 10 years, is instead of investing in other assets, because they know the fruitcake, if they're even decent at their job, they've been in this industry for the dad for 60 years probably. He knows the fruitcake industry is dying. The kids have to know the fruitcake industry is dying. So instead of milking shareholders, essentially, why not invest in other assets to grow the company? Again, that is from my perspective. From their perspective, I think they just want to cash out. They don't want to be in this business. Their dad built it. They just want to cash out and make money and retire. That's probably what it is, in my opinion.
Just wondering, what's your return rate if you invest in this business?
If they sell for total about $20, $25 million, my total return will be, what is that? I have it somewhere. It's in here.
It seems like they're going to sell. They're not going to change their mind. They're just into an agreement.
Well, and they can't really change their mind anymore because not only have they signed, I think there's a, what's the breakup fee? I think there's a breakup fee, a pretty significant one. like $1 million or $2 million, which for a $15 million company, that's a pretty good chunk of change. And then they've also signed an agreement with the purchasing company that they will not negotiate with another entity of any kind on a higher buy price. So they're essentially saying this is the deal and we're going to do it and it's going to get done. So where so I have my return in here. I know I calculated it somewhere. I did not calculate. I calculated in other chapters, but not this one. So if they sell out for $25 million, my return essentially would be a double. I think I bought it when it was around $12 million. So my return would be about a double.
A double, 100%.
Yeah. So
that's reasonable.
It's very good. But again, what's frustrating is up here I show the valuations of the company. And again, the real world valuations, I do kind of the base level margin of safety valuations I always do. And they were selling below that value. But if they implemented some of my recommendations, including their land that depreciated off the balance sheet, which I estimate about $5-6 million, they could have been worth between $50 and $100 per share, which would have been a triple or quadruple. So that's what is frustrating. Oh yeah, here we go. So here's the valuation, discounting the land by everything and including these. So including these, the regular valuations we already do, the EBIT valuation, and then adding in the reproduction valuation plus 50% of the value of their equipment and property. I value them between $83 and $122 per share as of, I think this was the end of 2016 or the end of 2015, one of the two. So what is that, a 5-6 times gain at the higher ends? So that's why this is so frustrating. Another reason this is so frustrating to me is because there is massive potential here that is not going to be realized, because essentially they're saying, I want to cash out, let's get out of the business and let's just get out. That's essentially what they're saying. So that, and that again, that's a lot of what, not a lot, but some of what Shafiq and I talk about with these guys overseas is this kind of stuff. Is, for example, the company that I'm working to sell right now, insurance brokerage company. I built out this very similar projections, I guess is the best way to put it. If they do things like cut costs, raise prices, do better marketing, and some other things we talked about, I can see them worth between $50 and $100 million within 10 years. Right now, we're working to sell them for $10 to $20 million. But again, kind of a similar situation is the dad wants to retire, he wants to cash out, that kind of thing. So what can you do about it? Not much. Obviously, he wants to sell the company. I'm working to sell the company for him. So if the founder wants to sell, you sell, even if there is massive potential that you see there.
But how many, sorry if I interrupt you, but how many shares they have in the company? Like they have more than 50% of all the shares?
I don't remember the exact amount of shares they own. I think it was between 40 and 60% of all shares. But this company has so little. So including, if memory serves me right, this company, including the insiders and executives, outside funds that own the company, I think there were only 530,000 shares total available to trade, to buy and sell. So this company will literally go days or weeks without trading any shares at all because there's so few shares to trade.
Okay. No, I was thinking about that because I think that if they want to sell the company, they still have to propose to the shareholder or not.
Yeah. And Essentially,
get
yeah.
the votation.
To answer your question, I think they control enough of the company that they can do whatever they want. So.
Okay.
So yeah, no, good point, because yeah, depends on the situation, but yeah, they essentially can do whatever they want because they own enough of the company.
Mm-hmm.
So
Okay.
what, and we haven't talked about that, so that's a good point. I'll talk about that now. What do you guys think of insider ownership, either positively or negatively, or low or high amounts? Do you guys have preferences for that yet, David?
Yeah, it depends. It depends how you see it. As you can see, in this case, it's negative, but in a lot of other cases, it's positive. Depend on the company. Yeah, depend on the founder. What the visions are.
Yeah, I see you nodding your head, Matteo. Is that pretty much what you think too?
Yeah, I think that in the end, even in this situation, it could even be worse with the management. I mean, if the management doesn't hold the company, they can start to make like a wrong acquisition, like pay too much for the company just to invest money to see that they're doing something, and so to like justify their higher salary. So they could even not sell the company, but go bankrupt, trying to make more money in a wrong way. So I think that in the end, having the ownership in the company is a good thing, and in most cases will always end up better than having the management that has just like 1-2%, and so their goal in that case is just to justify the higher salary, so to ask more and more salary. So they don't even have the, for example, before you talked about dividends, they will not even issue a dividend that in the end is good for all the shareholders. It's not, the best use of the excess amount of cash in this case, but still it's better than buying company, paying too much to buy another company just to like justify a higher salary, because maybe you seem to making more revenue, but in the end you pay so much for that company that you will not make a profit, for example.
So that's a great point. So that's why capital allocation is so hard, because literally there's two sides to everything.
Mm-hmm.
There's two sides to everything. If this company took my path, and let's say I'm wrong, let's say I put $2 million into a company and it goes bankrupt. Obviously, I would look to prevent that, and I've never had that happen before, but it could happen. Let's say the stock market crashes the day after we close purchase on $2 million of shares, and the stock market just crashes, like in 2007, 2008, 2009. I would look like an idiot. They would be unhappy with me because I lost their $2 million. And that would lead to a loss of capital, obviously. That would lead to lower value of the company. That would lead to all these things. So capital, that's why it's so incredibly hard. And that's why in the book, again, The Outsiders, there are, I think, 7 or 8 great capital allocators that he finds in that book. That's it, 7 or 8. Over the entire history of investing, he finds 7 or 8. So, yes, they could go my path. I'm confident that my path will work, but what if it doesn't? What if it doesn't work? Then they maybe cut the value of the company by 25%, and instead of selling for 20 million, maybe they sell for 15 million or even lower if the stock market crashes. You have to think about all these kind of things when you're worrying about capital allocation. And if you don't know how to do capital allocation, you probably don't think about these things at all, which is incredibly scary to think about as a public company manager or CEO. If you don't even think about these things at all. Does that make sense, guys?
Yeah.
So, yeah, when I present something to these guys, like for example, I present these things to these guys overseas, and I say the same thing. essentially is I'm confident these will work. Why? Because I know they work from previous experience and they're working at other companies we're advising, which are both true. They're already working at some of the companies we're advising and from experience of learning about this stuff. But what if they don't work? What if the stock market crashes tomorrow? So I go through a scenario and essentially I say, I get to the end of the analysis and I say, what if I'm completely wrong? What if only 25% of these recommendations work? Meaning 75% of them fail, which is a huge failure rate because of my recommendations not working, just because they sucked, because the market crashes, because the economy crashes, whatever the case may be, it doesn't matter. What if only 25% of these work and 75% of my recommendations fail? And then I go through the entire valuation and still usually, if only 25% of my recommendations work, again, because I use so much conservatism in my estimates, they still double or quadruple the value of the company in 5 years. But again, not everything is going to work. Not everything works kind of mathematically like that. What if I put 20% of your entire invested capital into an entity and it doesn't work? That essentially means you lose 20% of the value of that of your invested capital, which could be a significant portion of the company, which could lower book value, which could lower the value of the company, which could lower your ability to operate. That's why this entire thing of capital allocation is so difficult. It's definitely far more art than science. Does that make sense?
Mm-hmm. Yeah.
You guys like talking about this capital allocation stuff? We haven't talked about it much.
Yeah. We didn't talk much about.
What was that, David?
So I'm just asking, you said what kind of real life business would be like, like A+ class quality, they have competitive advantage, they can compound capital long term, all that stuff like in Google or something. So what's a real life example of businesses that fit your criteria? Maybe not in terms of valuation, but like the quality of the business.
The quality
like
of the business? This one right here, Paradise Inc. Again, management isn't great in my opinion, but they have the opportunity to become great. So I would probably put this company on, let's say you said A++. I would say probably this is a B, B-, C+ area. Another company I own, actually it's an Australian company. They operate in the United States. AUTLY is the ticker. Austell. They have competitive advantages that they're working to create. They operate very well. They cut costs. They are, in my opinion, doing very well. And I think they're, if I remember right, they're more than a triple for me at this point. BSIY ticker, BE Semiconductors, that's another one. That is, they cut costs, raise prices, have competitive advantages. At one point, they were a 5X for me. I think they're a 2 or 3X now. Altria, Philip Morris. I used to own stock in those. I don't anymore. Same things, competitive advantages, pricing power, economies of scale, all that kind of stuff. Intel, I used to own. They have competitive advantages, same stuff. Frankly, there's not many companies out there though. That's why I'm struggling to kind of think of some.
Amazon, Google, Facebook, Apple.
I would probably put Amazon in there. I don't know about Facebook. I probably wouldn't put Facebook in that great group. Amazon would definitely be in there. Google would probably be in there, but technology again, and this is the same thing with Facebook, is technology changes so fast that over the long term, I don't know if they can keep up their competitive advantages. Amazon, I think, will, because they're not just selling stuff anymore on Amazon. They're essentially creating entire marketplaces on Amazon. They're having people like you and I used to sell stuff on Amazon, and Amazon would take a cut of everything I sold on Amazon. Amazon is becoming a worldwide marketplace for everything. Plus, it has Amazon Web Services, which is taking over the entire internet in terms of servers and stuff like that. Whole Foods it has, which has pricing power. Yeah, I'd probably put Amazon up there in terms of the actual like real world great businesses. But in terms of stuff you guys know, probably Amazon off the top of my head, Amazon, Philip Morris, Altria. And off the top of my head, that's probably it. In terms of absolute great companies that over the long term should have competitive advantages.
Berkshire. What about Berkshire?
Berkshire, it's interesting to see what happens after Buffett dies. I think he's built the company well enough that it will survive and thrive. But again, capital allocation is such a difficult subject that I'm interested to see whoever takes over the actual capital allocation part does. Because I don't think it'll be Ajit Jain. I think he's going to be the insurance, because they've kind of broken it off. It's Ajit Jain. He runs the insurance side of things, and who runs the Lou Simpson? Does he run the management / operation side of things? But it's interested to see. I'm interested to see what happens after Buffett dies. If Munger was, say, 20 years younger, I think it would have been a slam dunk that it would have continued going well for another 20, 30 years. Because I think Buffett and Munger are great capital allocators after studying them for so long. But Ajit Jain, I don't think he's great at insurance, but I don't know if he has the personality to necessarily allocate literally hundreds of billions of dollars of capital well. He's great at insurance, but I don't know if he has necessarily the mindset, because you can learn all this stuff. And this is what I tell to clients is, I've learned all this stuff. I'm nothing special. I've just taken the time to learn it. But if you learn it and you don't have the proper mindset to actually not only think about all these different things, but actually have the patience and the proper mindset to wait and be patient, then it doesn't matter. It's like with investing. You could learn all the value investing techniques, all the valuations you want, all the terminology you want. But if you aren't patient, if you aren't disciplined to stick to your processes and wait and buy great companies or great situations, I guess, then it doesn't matter. That's why if you have the trader's mindset, you want to get in and out of things as fast as possible. Like I would literally almost at least once a week, I get somebody talking to me about Forex. I don't want to talk about Forex. I don't want to trade in and out of stuff. I want to buy something and sit and wait and learn about the company. And I just don't have that mindset. I would be a terrible trader. And traders would be, for the most part, terrible value investors. Unless you're looking at some kind of special situation, short-term special situation, which is possible. A lot of Joel Greenblatt wrote an entire book about special situations. And he did very well with that for years. So it's possible. I just don't have the mindset to do that well for a long time. I'd rather do this kind of stuff with you guys, learn, go over financials, and think about long-term stuff than, oh no, what is my Amazon shares? What are my Amazon options? What have they done in the last 20 minutes? Type of thing. Does that make sense?
Yeah.
I think there's not, until more information comes out about the liquidation, frankly, there's not much we can go over it.
Where do you read about the price that they decided to sell the company at?
So they released, where is it? They released in, I can't remember what they called it. I think they called it a prospectus or something that I found. It was like an 80-page doc that I read one day. and it talked about, here it is, maybe. Okay, so it's like a financial report, except, what is it? Not that. Okay, so this was just an 8K. Usually when companies do something like this, it's, what form is it? Hold up. I can't remember what the form is called, but it's prospectus. It's kind of like a prospectus, like when a new company issues shares or bonds or whatever, they issue a prospectus. I can't remember the exact terminology or the exact form name, but they release a document talking about all the details. So they go through this entire thing and they repeat things like 3 or 4 times, which drove me nuts when I was reading it. Oh, this isn't even the doc either. So here it is, I think. Here's the doc. So the purchase, what is it called? Asset purchase agreement. So this is just the agreement. This isn't actually the release of information. So they talk about everything in here. So, and the reason I can't estimate exactly what they're selling for is because from my reading of this, is while they have agreed to a price for the business operations with Seneca Foods, they don't know what they can or are going to sell the real estate for. Which, I mean, that makes sense because you don't know what you're going to be able to sell the real estate for until somebody actually offers you something, correct?
Correct.
So let's see if I can find the actual amount in here from the sale. Okay, so the aggregate purchase price for the purchase asset shall be $9.4 million rounded up, subject to adjustment pursuant to blah, 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 plus the assumption of the assumed liabilities. The purchase price shall be paid as provided in section 3.02.
So, a good price?
Yes, in my opinion, it's probably a fair price, if a little bit low in my estimates. It's probably a fair price. Yeah, it's not obscenely low like what we saw in the Dole thing.
So it's 9 million. It's that one.
Yeah, 9.4 million. And
But this is to sell the business unit plus there is liquidation.
My girlfriend here.
Get her in here. Let her learn about some value investing.
What? She wants to join.
Okay.
Already.
So yeah, the purchase price is about $9.4 million.
Yeah, come on.
Probably a fair price. I estimated years ago that they had about $6 to $8 million in depreciated value of their real estate. So that would bring you to about $17-18 million. About. Can they get higher price for the real estate? Possibly, yes. Knowing where they work, again, I live about 35 minutes from where they are working. So I don't know exactly where they're, and I haven't toured their facilities. I know the area, and it's not a great area. So can they get the $5 or $6 million? Can they get a higher price, or will they get a lower price?
But so they have the land and they have
yes,
they own the land, so they will sell that in liquidation after.
Yeah, so they own the land and the equipment outright, and the land has depreciated off their balance sheet completely because they've owned it for so long. So it doesn't even show up on their balance sheet as any value. At least the last time I read their balance sheet. I don't know what it says now. But as of right now, their balance sheet doesn't show any value. Or as of the last time I researched them fully, their balance sheet doesn't show any value in terms of this real estate that we're talking about right now that they're going to sell.
Okay, so you think that 9 million will be for the business unit plus the money for the land, the facilities, the machine. So the total will be around 20, you think?
That's my best guess. Yeah, between 15 and $25 million, depending on how much they can get for the land. Probably closer to the 18 to $20 million range. Yes, correct.
So when they talk about business units, what they are selling actually?
They are specifically selling. Okay, where are the assets at?
I mean, I think even some machine, I don't know, for the production.
Okay, so they're selling the following assets: all inventory, finished goods, raw materials, all furniture, fixtures, equipment, contracts, including IP.
So intellectual property, machine, equipment,
Yes.
inventory, okay.
So in here, they're not selling the properties.
Yeah.
Here, they're actually not even selling. It doesn't even state specifically that they're selling the operations, but I mean, they're selling everything to operate the business. So.
Yeah, I think so too. Yeah.
So.
Hi, Jason.
Hello. How are you?
Hi.
Hi, Matt.
Matteo.
Mateo.
How are you?
I'm good.
You want to learn about value investing?
No, I'm shy.
That's fine. You don't have to talk much. We'll do all the talking.
Okay.
So, yeah, in here, I would think, yeah, probably 17 to 20 million dollars is probably what they're going to get, depending on if they get somebody wanting to buy their real estate for a crazy amount. Is it a fair price? I would say yes. Is it the price they should be worth at the higher level? No. In my opinion, no. Not even close. They should be probably valued, again, if they implemented some of my recommendations and did some work to improve the company, it could be worth, what was it, 5x, 6x, David, is what we were talking about earlier, in time. But again, they don't obviously want to do that. So.
So if they have at least 50%, they will get 4.5 million just from these.
Yeah. Well, they'll get the full amount from this, from the actual purchase, because they've already agreed to that purchase price for the operation. It's just a matter of how much money they can get out of the real estate and the other things that they're not selling to the company yet.
Mm-hmm. Yeah.
So yeah, I think probably 17 to 20 million dollars they'll end up getting after fees and taxes and stuff like that. But yeah, I mean,
so
go ahead.
They have already had like a votation to do the liquidation, the selling, or I mean.
Yes. So this is the initial agreement that they released in April. And
okay.
According to this agreement, again, if you guys want to read it, go ahead. I've already read it. It's quite boring. Even more boring than most financial statements because they just repeat it over and over again.
Yeah.
But by my reading of this, they have agreed to sell the operations, and they are working. They are beginning the process. This was kind of a notice, I think, is how they put it, a notice to shareholders that they're doing that they're beginning this process. So they're selling the company. I think it's supposed to close like September, and then they're working to liquidate the company in that time.
Oh, okay.
Let me back up. I think they are going to finish the inventory, building the inventory for the holiday season, which is their big season. And then after they close the sale, I think September, October, they're going to start liquidating the real estate, I think is what they're going to do actually. But they begin learning about that process of what they need to do and all that kind of stuff. So this, yeah, it was kind of termed as a notice to shareholders type of thing. Yeah, but I mean, yeah, this is even more lawyered up than most financials is. That's why it drove me so nuts reading it.
Yeah, because or for legal reason, no?
Yeah, to cover their asses, like we've talked about before.
Yeah.
Make sure nobody gets sued after the sale of the company.
Yeah, I mean, they want to have the money, not have any problem. But so they have like how many people from the family they are now owning the company?
So the dad is Melvin Gordon. He's not listed on here because I think he's just the chairman right now. This is the son. I think this guy is son-in-law to one of one of Melvin Gordon's daughters.
Oh, okay.
There's another guy that was like a cousin, but I think he was like the corporate lawyer or something, so he's not listed on here. So it's pretty much a family-run business. Family-run, $15 million business. And they just want to sell, apparently. So.
Yep.
You guys have anything else? I think this is pretty much all I had to talk about today. You guys have any questions, comments about anything?
I mean, like, so your idea was to use the excess cash to do capital allocation, but also to invest even in business that are not correlated to their industry.
Yeah.
Okay, so to make like a small Berkshire Hathaway, so start to invest in other company and doing the same with the profits that you get from the other company. Okay.
Yes, that was my idea for them. So the first, and I've actually built a model for this called the 7 stages of capital allocation that I work with these businesses on. The first stages are, or actually the first stage is things like cutting costs, raising prices, reworking contracts in more of your favor, talking to suppliers to lower your costs that way, these kind of things to build on your profitability you have now. Then after you get to that stage of having more profitability, more cash flow, that kind of stuff, then investing that capital in other assets that return more money and more excess cash flow to you, which again furthers this entire cycle of things.
Yeah.
So, and we can talk about that at some point too. I mean, it's not proprietary information. It's just information I came up with after studying this for so long, for 12 plus years, is you start focusing on the internal things, then you go to external things, then you work on investing the cash, then you complete the whole cycle and just keep going. I'll show it to you guys right now. Where is it? So am I sharing my screen still?
Yeah, I can see it.
Okay, so this is the graphic one of my teammates created based on the information that I've learned over the years. So obviously start at 1 and then this whole cycle repeats over time.
So before you focus on what you can improve on your business and external focus, what it means, like expanding some, like buying company of the same industry.
Expanding geographies, expanding industry you're involved in. For one of the companies overseas in the UAE, I built a model for them where they should expand geographically in terms of the Middle East. Should they expand to, or specifically what cities and what countries they should expand to, if they want to expand, if they still want to go down that route. That's that kind of things, the expand outwards part of things.
So after capital allocation, using other people's money to positively leverage a return, but that's how you can make that with a company.
Investment float.
Okay. So insurance company.
Well, not necessarily even just insurance companies. All companies operate on some version of float. They have accounts payable, they have accrued liabilities, They have all
It's
these
true.
kind of things that they can invest to improve operations and improve margins, but they don't necessarily know how to. Again, this is the entire thing of capital allocation. This is kind of the grand level strategy that I've come up with right here. So this includes everything. And then the next one is compounding, which obviously we've talked about quite a bit. You guys know what that is. And maybe this is what we can talk about next time.
Yeah, that's interesting. This part. Yeah.
Okay.
That's pretty cool.
Yeah, the float. I remember investment float. I mean, I read even your book that you gave me in Madrid. So that's true. I mean, this is exactly how Warren Buffett did it, right?
Yes, this is exactly what he did.
Exactly that. Yeah.
Yeah.
Yeah, I think next time we should do like a lesson just on this.
Okay, perfect. I love talking about this kind of stuff, and frankly, even with the company owners, I only delved into a little bit of capital allocation just because there's so many layers to everything. Again, like
but I saw, but he replied to you. This one, you said no.
This one, what?
The owner of this company replied to your email, to your.
Me and Shafiq are working to get them signed up still.
No, I mean the owner of this company, the Paradise Inc.
No, they didn't respond to me at all.
Yeah?
They didn't respond.
Usually they reply when they are so small. Like, yeah. I mean, even if they are not interested, they say that, you know?
Yeah. No, if I remember right, I sent an email to the company, 1 or 2 emails, and a physical package with the whole like 30-page document to them, and they didn't respond.
Yeah. That's strange.
Yeah.
Anyway, can I get that? Can I get that documentation to read?
This graphic right here?
Yeah, this graph and the documentation about Paradise Inc.
Oh yeah. I'll send both to you guys. I'll just post them in the master class.
Okay, in the Facebook group. Okay. Yeah, that's great.
Yeah. So yeah, because this, I mean, literally, you can spend hours or days talking about the different layers. We talked only about a couple different layers of capital allocation a day. So yeah, I love talking about this kind of stuff. So we can talk about this next time. Again, I'll be in San Diego next week, so I won't be able to meet next week. But
so in 2 weeks, okay.
Yeah.
So it's not on next week?
What was that?
Is it still on next week or?
No, I'm going to be in San Diego next week.
Okay, so the week
vacation
after.
with my family. So we'll probably be going to zoos and stuff like that and be out. So I won't be able to.
Yeah, in 2 weeks, it's okay.
From now. So capital allocation is good with you too, David? 2 weeks from now? Cool. All righty. Anything else, guys, on what we talked about today?
No, I think that's all.
Find another paradise, Jason. Don't be discouraged.
What was that?
Find another paradise.
Well, I've already got several others in mind. I just need. I'm getting frustrated because I know how. And this is. I explained this to my wife and my team the other day. Is I learned backwards. I know how to take companies, say, from $1 million to $100 million companies, but I don't know how to get from 0 to $1 million. That's the stage I'm in right now.
Actually, Warren Buffett was saying that's the most difficult part. Yeah. I mean, even the other part is still difficult, but the from 0 to 1 million, it's like.
I think Munger actually had a quote. He said, "Getting the first million is a bitch."
Yeah, it's a bitch. Yeah, I think like this because I think it's true. Like it's like this.
Well, and when you think about it, it's completely different mindsets. You essentially have to go 0 to $1 million. You have to build everything from scratch. Going from $1 million to $100 million, you have already a base there, and then you're just building.
Exactly. Exactly. I think it's like this, like from 0 to 1 million, you cannot have I mean, you cannot follow a path.
Yeah.
You have to be a little crazy, you know.
Yeah.
You cannot follow a path. After, you can follow like these stage that it's still difficult to apply, but at least you have some kind of rule, some kind of path that you can follow.
Yeah. Yeah,
That's
well,
the difference,
funny
I think.
because I even some guys I've worked with in the past are multimillionaires. I've consulted with them and
Mhm.
actually met them in person. I went to I met them in person and was helping them with a project a couple years ago. And we were
Mhm.
talking, and I mean, these guys, one of their businesses does $20 million a year, so they're legit multimillionaire, and they run
Mhm.
multiple businesses. And he said he's gone up and down and up and down. He's lost money, a lot of money, and he's made a lot of money. And he was
Yeah.
like, he turned to me and we were talking about that. I was like, yeah, I'm struggling to get up to that point. And he was like, well, knowing you like I know you, once you get to that point, you're going to explode and you're not going to lose a lot of money. You're going to kind of take a rocket ship. He didn't say that, but he was like, you're going to just kind of take off after you get to that point. It's just a matter of actually getting to that point now. So,
Yeah. Mhm.
but yeah, I'll send you guys these docs. I'll put them in the group, and I'll put this video in the group too if it loads properly, like last week, which hopefully it does, because this stuff is incredibly valuable. Hopefully you guys found a ton of value in it.
Yeah.
And it's not normally what we talk about, but again, hopefully it's not just necessarily the numbers. It's more actually thinking about the proper mindset and having the proper mindset.
Yeah.
So hopefully you guys found it very valuable. But yeah,
I mean, I find valuable even to find some business that have some great capital allocators in, you know, like if you invest in a business and you can recognize that the owner is a good capital allocator, you can find a really good investment.
yes, and actually, I think you guys are familiar with Ian Castle of Microcap Club.
Yeah, of course. Yeah.
Okay, I think he posted something on LinkedIn a while ago, is where he's only looking for companies with great capital allocators now. He's to the point in his investment only looking for companies with great capital allocators. And frankly, again, in the entire Outsiders book, there were 7 or 8. So if you do find one, like you said, hold on. Well, another perfect example is Berkshire Hathaway. When people bought into Buffett when he was in his partnership days,
Exactly.
or just his even earlier Berkshire Hathaway days, they became millionaires and sometimes billionaires just by holding their shares because they had hooked their coat, I guess is the saying, to a great capital allocator. So that's a perfect example.
Yeah, that's true. Actually, I read his book, and they did even Intelligence Fanatics, where they study the great leaders. So I read their books, so I know them because they invest in small companies. So for that reason, I reach them. Like,
how are those books, by the way?
What?
How are the Intelligent Fanatics books?
You read that?
No, I haven't yet.
Okay. I suggest you. Yeah, it's a great book, Intelligent
Are
Fanatics.
they? Okay, cool. Yeah, I'll have to.
I think David.
Yeah, his internet must have dropped or something. Oh, battery died on laptop.
And it's a great book because it talks about all these great leaders that actually many of them are great capital allocators. So it's all about that in the end.
I'm just messaging him back real quick.
Yeah, sure.
Okay, so his laptop battery died, so he's not coming back.
Yeah, because the time that okay.
Yeah. So yeah, unless you have any questions, comments, concerns, anything, I'll see you in 2 weeks, and I'll post this stuff hopefully later today if the video uploads properly in the masterclass group as well. So.
Yeah, that's great. And in September we will start again with the coaching sessions.
I'm excited.
Yeah, I'm excited too because I mean I missed that lesson during the week, you know. So
yeah, so do I. I love. If I could pick one thing, and it's not scalable, I know that, but if I could pick one thing, just one thing to do, it would be the one-on-one coaching. I love that more than the group coaching. I love that more than the actual, like the masterclass teaching. And I know it's not scalable, but I just love doing it. So looking forward to that.
Yeah, because you love talking about that, about this topic. So I can understand,
Yeah, I never have any notes when I talk about any of this, so I could talk about this forever, essentially. I've been learning about this so long, so.
Yeah. Okay, so yeah, you wrote me the same, David. So okay,
All right, sounds
so
good,
we
Mateo.
can. Okay, so we see in 2 weeks. Bye.
Yep.
Have a
See you
good
in 2
day
weeks.
and have a good holiday. Bye bye.
Thank you. See you soon.